Hello, chart watchers, and welcome to this Wednesday, July 10th, 2019 Market Watchers live show with your hosts, Tom Bowley and Erin Swenlin. For those of you joining us for the first time today, welcome to the show. And for our regulars, welcome back. Well, it was a big day on Wall Street. We have reversed a little bit off the earlier highs. We can see the Dow Jones Industrial Average up 87 points. The S&P 500 hit 3,000 for the first time in its history, backed off. But it is starting to regain some strength, currently up 13 points to 29.93. The NASDAQ breaking above 8,200. I think this is very bullish as well, up 52 points on the day. The Russell 2000 continues to lag on a relative basis, only up 2 points, continuing to sideways consolidate here. 10-year Treasury yield gapped up earlier today, was near 2.10%, but is currently down to 2.05%, slightly below yesterday's close. Volatility index taking a big turn to the downside. The VIX down more than 6% on the session. Technology leading to the upside, along with energy and communication services. Financials, though, on the other end of the spectrum with a minor loss so far today. The mobile telecom group getting a big lift today from T-Mobile being added to the S&P 500. Home construction stocks rebounding today. This has been a group that has been downtrending since the early part of June. They've been lagging, but we are seeing a little bit of strength here. Like to see it get back up above these moving averages. Specialty finance came down. Nice bullish test of the rising 20-day moving average, right back in the front seat, driving the market back to the upside. As I mentioned, T-Mobile having a really strong day today, up 5%, threatening to break out above the highs from the last couple of months. And then one of the best earnings reports so far here early in earnings season, Helen of Troy came out today, beat top line, beat bottom line, raised guidance, and you can see the huge reaction to the upside here in HELE. All right, Erin, it is hump day and the markets, I tell you, S&P 500, 3,000. Never been able to say that before.
I know, very exciting. It's always fun when we hit these milestones, and wow, I would have never thought. I have to say, I would never thought like 5 years ago.
Well, as I wrote in Chart Watchers last week, I think people are going to be surprised as to how fast we get to S&P 500 4,000.
Well, we'll see.
I just believe that the market is setting up. I think you got just tremendous amounts of fixed income investments that are going to liquidate over the next couple of years. That money's got to go somewhere. If the global economy is strengthening, why wouldn't it move into equities? I think that could be the catalyst that really drives prices higher. But who knows? Just my own conjecture.
Yeah, it's a matter of the timing. I'm sure we'll reach that. We'll reach that point, but the timing. We'll have to see.
I say 2 years. I say by the end of 2020, but we'll see.
Right.
Anyhow, we do have a very special guest today. He was on about 3 months ago, and I tell you, really gave some great forecasts. Tony Dwyer is back with us. Tony, it is great to have you back.
Always great to be here. Thanks for the opportunity.
You got any thoughts about S&P 500 4,000? Am I crazy?
That has nothing to do with that call. However, I think it'll get there. It's just a matter of when you look at over the history of the marketplace, unless we go into a permanent depression or become Japan-like, I don't see any reason that ultimately we won't track the level of earnings.
Yeah. All right. Well, I know you've got a great presentation lined up for everybody, and trust me, you don't want to leave your seats on this one. Tony had a great presentation a few months back, and we were really excited to have him back today. So hang in there with us, Tony. We'll be back to you probably in about 15 minutes or so.
Kai, great. Thanks.
All right, Erin, you ready to get this party started?
Absolutely, I am. Upcoming schedule. Tomorrow we do have Greg Schnell coming in. Martin Pring will be joining us next Wednesday. Julius DeKempener, Mr. RRG, will be with us on Thursday. And then that following week is going to be Relative Strength Week. So mark your calendars. As for today, we have, of course, Tony. He was introduced earlier, so he'll be in the first part of the show. Then we will do the 10 and 10 with our first symbol being Smart Sheet. Finally, we will finish with the Scooter Report, and then we have some very interesting chart breakouts for you. So let's go ahead and get started with some technical news and headlines.
All right. Well, we did have one economic report out this morning, not really a widely followed one, but May wholesale inventories came in as expected, rising 0.4%. As far as the 10-year Treasury yield goes and the bond market reaction, You can see relatively flat today, still sitting right at about that 2.05% level. But one thing you can already see here in July with just that little bit of a bounce there in the 10-year Treasury yield, one of the things that normally happens is you see money rotate into the stock market, and you can see the stock market already very strong last 5 to 6 weeks. If money rotates away from treasuries, that would be another catalyst to boost things to the upside, no doubt. Earnings, we did have a few earnings reports out last night and this morning, and they came in pretty good, I would say. I mean, it wasn't I wouldn't say it was a windfall of positive results, but we did have Levi Strauss beat. Helen of Troy, as I mentioned at the opening, did beat, and WD-40, WDFC came in ahead of expectations as well. MSC Industrial Direct, though, failed to meet its expectations. So let's jump in and take a look at a couple of these charts. First is Levi. And I'm going to actually bring this up on that relative chart that I like to use. And you can see Levi Strauss dropping even after coming in with better than expected results. The top line did beat, bottom line beat. They guided their fiscal year 19 earnings before interest and taxes higher, but they missed their gross margin estimates. And the problem is when you're in a group that is not breaking out, like the clothing and accessories group, which has been lagging the S&P 500 and not too far from a 52-week relative low, if you're in that part of the market, you really need a blowout report. And apparently it wasn't good enough. Levi Strauss, you can see down 12% today. Not a good reaction at all. However, let's flip over to Helen of Troy because this was a big one. They came out, their top line, $376.3 million versus $351.4 million. So 25 million revenues over and above the estimate. Bottom line, $2.06 versus $1.68. And then they guided their fiscal year 20 revenues and earnings per share higher. And this was a very strong report, strong reaction. We are up 12%. I think in the short term, I would be watching to see if we can break above 145 on the close, however, because we have gotten up to this level a couple of times with the earnings report, everybody jumping in. If we leave that long tail above that double top there and fail and come back down, I think eventually we make the breakout. I just think we'll have to be careful for a possible short-term pullback, really striking some fear into those who are getting in at the high of the day. So let's see how we finish. I like this stock going forward, but I think if it doesn't get the breakout on the close, it could be a little short-term head fake. We might be able to get a little cheaper on a pullback. WDFC, this is WD-40. Really a very nice reaction today. Stock doesn't trade a lot of volume. I just wanted to bring it up because it has shown such strength today. Very strong volume today relative to what it normally trades. And it looks to me like this downtrend's been broken, and it's in a pretty good area of the market, which has been one of the areas leading the S&P 500. So good surprise here, beating on the top line by about $4 million, roughly 4% above estimates. $1.30 versus $1.22 on the bottom line. I think WDFC looks really good. And then let's go back and look at one that didn't meet expectations. MSC Industrial Direct. Stock was already in a downtrend. Look at the relative strength, or in this case, relative weakness of this stock. It has been moving lower relative to its peers for about 8 or 9 months. So the fact that they came out, missed on their top line, missed on their bottom line, guided Q4 revenues and earnings per share lower should come as no surprise. The Wall Street, the charts, they've been telling us this. The stock has been ignored, been traded down. You can see the volume pretty heavy over the last 3 or 4 months as it's moved lower. Relative weakness pretty clear, and the stock underperforms. All right, I wanted to go over one thing in my article from today. I wanted to talk about these FANG stocks, and this is why I think that the relative strength is so important in the market. So let's go ahead and pull this up, and I'm going to stretch this chart out a little bit so that we can fill up the screen here. But I think you're going to see a big difference and maybe a little bit of an eye-opener on this chart as we look at the different FANG stocks. So here we go. S&P 500, since that June low, been going straight up. Beautiful. This is the relative strength of the 5 FANG stocks. Look at Facebook, moving up faster than the S&P 500, breaking to a new relative high. The market likes Facebook. They've been out visiting the company. I think you've got to pay attention to this. I look for a really strong report out of Facebook. Amazon, same thing. The relative strength since that early June low. This is another name that's leading the market, breaking out to a new relative high. I love that. Apple, moving higher, but still off of its earlier relative high. So I like what I'm seeing out of Apple, but it's not exactly outperforming the S&P 500 if we look back to where it was just 2.5 months ago. Netflix, again, as we move down the line here, you're seeing a little different. You're looking at the relative performance here, and hopefully it's giving you a little different picture. Netflix topped almost a year ago versus the S&P 500, and while it hasn't been a huge underperformer, it's not been a leader. And each time we get a little bit of a spike in relative strength, seems to be followed by a little bit more weakness. So I'm not quite sure what to expect here coming out of Netflix. I also would watch that 385 level on their absolute chart. Need to get that breakout until we get above that level. 385, 390, I'd be careful. The last one, though, look at Google. Now, Google has been a really poor performer for the past 2.5 months relative to the S&P 500. It was trying to break out above its 50-day moving average, may have done that yesterday. But on a relative basis, folks are really being careful with Google. And when I see everyone else, particularly Wall Street, not supporting one of the big names like Google, it tells me to stay away. So if we go in and take a look just at the Google chart here, and we look at the relative chart, it did get above the 50-day moving average today, but look at the weakness in Google for the past 2 months. While the S&P 500 has been going higher, here's the relative strength to internet stocks. Here's the relative strength, or really weakness, to the S&P 500. We really, really need to be careful here with Google. I think it's telling us of the 5 FANG stocks, I think this is the one that could really disappoint based on the heavy volume and the selling. I think there's a lot of distribution. Not saying, it's definitely going to miss, but I just feel like there's a reason why we're seeing a lot of folks moving out of Google, something to keep in mind. All right, let's go over to the dashboard, and I want to show you one stock. Oh, it's not on here anymore because I think some of these semiconductors have moved lower. But one stock that is making a pretty good move today in terms of scooter is Micron. And when you look at Micron, here's the big move that we've seen on its scooter of late. You can see the PPO has been very strong. And as I look at Micron, what I like to do when I look at these scooter movers is I like to compare the fact that we're getting, a movement higher in the scooter. That's a good thing. Tells me to at least be alert of maybe something taking place on the chart. When I bring this chart up, I see a couple of different things. Number one, 5 times now, maybe 6 times, we've been up to this 44 level, have not been able to get through. A breakout above 44, I think, would be very bullish. One big difference now that I see, and that is the volume coming in on this move to the upside has been incredibly strong. Check out the rate of change here. These are the 2 rate of change numbers that impact the scooter score. They are both rising. You can see the last time we had a big move, the 20-day rate of change did well, but the 125 was still well below the 0 line. Both of them are moving. I think if Micron breaks above $44, this is a stock you definitely want to keep on your radar. For that reason, it is our scooter mover of the day.
All righty, it is time for some upgrades and downgrades. Some interesting ones, I would have to say. So let's go ahead. We're going to start off with Core Laboratories. They were upgraded today by B of A Merrill from a neutral to a buy. And let me get my little crosshairs here so I can get. All right. So they have moved their target to $63. So that's right about there. So they're lining it up right there with that overhead resistance that is linked right there to the lows that we saw back in February and March. We're making a pretty nice move here with a nice rising trend line right now, which I like. And then you could also see a symmetrical triangle here on the end, and the expectation, honestly, out of this would be a move that would continue the trend we are in. And in the shorter term, that, of course, would be moving to the upside. And a target of $63 does make a lot of sense to me. We have a PMO buy signal. It's now just getting close to the 0 line, so there's room to ride that. So I thought Core Laboratories looked pretty interesting. CMCSA Comcast, it was upgraded today by Goldman from a neutral to a buy. They have moved their price target. Let me make this a little bit bigger here. They have moved their price target from $44, which is pretty much where it's at right now, and they have moved it all the way up to $54. So let me get that horizontal line there. And I'm going to move this out. $54. So we're looking way up here as the price target for the upside here for Comcast. I mean, I like the look of this chart. You know, this is if you look at it in a more long-term frame of mind, you have a flag formation, I would say, right there and right here. So I like the look of Comcast right now, and a nice breakout, really, especially when you see where it's been having trouble with that overhead resistance. PMO is looking good and rising and certainly not overbought. The other one we have is WBT Well-Built, and this was upgraded by Citigroup from a neutral to a buy, and they have moved their price target from $17. Hang on here, let me get rid of that. They have moved their price target from $17 right about here, which of course you can see was the overhead resistance in the short term. It's always interesting to see how these match up, isn't it? And they have moved their target up to $19, which matches up with these lows right about here. So pretty interesting. I think that you could certainly see this move to the upside. I'd be a little concerned. Momentum is starting to shift downward in the shorter term. And you know, it needs to get above that overhead resistance of their original price target. All right, let's move to a few downgrades. Acacia is the one that I found especially interesting here. Acacia Communications was downgraded by 3 different agencies today. NEDA moved them from a buy to a hold. Piper Jaffray moved it from buy to neutral, and UBS also buy to neutral. UBS and Piper Jaffray also set targets at $70. So here's where it's trading right now. We had that nice pop, and right now that would be the price target now at $70. So it does appear that the target's raised, right? But we're looking at a neutral to hold position. So it's not unusual to see a price target be a little bit higher than what's going on there, even on a downgrade. Deere was downgraded today by a UBS from a buy to a neutral, and their target was raised from $158 right here, and they have moved it up to $167, which it would be right here. Not quite to those tops that we saw earlier. Again, you know, it is a downgrade, but it's going from outperform to perform. So they're still looking at, I'm sorry, it went from a buy to a neutral. So they're not really downgrading it to, you know, sell position. And then finally, the last one would be OLED. Oppenheimer downgraded it from an outperform to a perform, and they did not give us any price target, but let's go ahead and just look at this picture on a little bit longer term basis. So you can see overhead resistance here would be back here at the January top, and it's making that its way up there. I would look for that move to the upside. I do see a little bit of, in the shorter term, the PMO and the momentum is trying to turn over a little bit here, but it's still above the 0 line. I still like the look of it. So despite the downgrade, I still think there's a little bit more room to move to the upside for OLED Universal Display. That's all I have for upgrades and downgrades. Here are the listings. We will be right back with our special guest, Tony Dwyer, after this.
The point of on trend is to keep you on the right side of the trend. Mostly dealing with stocks and ETFs, I'm going to point out bullish setups on stocks and ETFs that are in uptrends. I'm also going to look at some downtrends, but those are designed also to tell you which stocks and ETFs to stay away from. The main point is to stay on the right side of the trend, the uptrend.
Okay, welcome back, everybody. It is my pleasure to bring back Tony Dwyer. He is the market strategist with Canaccord Genuity. Tony, you were in here a few months ago. You had an excellent presentation. I know one of the things that you talked about was the fact that you thought that there was plenty of reason for the Fed to turn more dovish, namely that inflation had moved below their target level. And that's exactly what's happened. I mean, we have seen the Fed now, Jerome Powell testifying before Congress this week has indicated that the Fed is prepared to act. That's helped lift the market today. Great call a few months ago. Hopefully you have some more great information like that for us today.
Well, thanks for having me. And I think it's kind of rare in our game that you can have a kind of a unique call that's so aside from consensus. And I think maybe 4 or 5 months ago, thinking that the Fed was going to actually ease was pretty well not accepted as the norm. And now clearly it's the norm. There's 100% probability of an ease priced into the market, into the bond market, according to Bloomberg. So it's really hard to say that it's not going that way. I like to remember that I was fortunate early in my career that you guys all know Marty Zweig. Remember Marty Zweig, right?
Mm-hmm. Yep.
Marty was very famous as a technician and fundamentalist, which is me. That's how I learned. He was very famous for 2 lines: "Don't fight the Fed and don't fight the tape." And if you think about that, why isn't it follow the Fed and follow the tape? Because human nature is every time the Fed is easing, you want to fight it because there's something fundamentally seemingly wrong in the economy that's making the Fed ease. So I think one of the value adds I can have here before we go into a few slides is to understand what is the differentiator of why the Fed is easing and we called for it, not because there was some kind of economic catastrophe. Clearly, there's a sharp slowdown in economic activity globally and now domestically, but that's supposed to happen after you get the kind of move up in rates that we had last year. And I think what people are missing or maybe missing here, who knows, maybe I'm missing it and I'm totally wrong, but what people may be missing is just like those higher rates led to a slower economy today, won't the lower market rates lead to a better economy tomorrow, meaning over the next 6 to 12 months? And I think that's why the market is going up right now. Yes, bad news is good news because it means the Fed is eased, but the market rates have already done it. So let's get into it. Let's look at what happens to the equity market around the initial Fed rate cut. And as you know, a lot of these charts these are also up on dwyerstrategy.com. Totally shameless plug that I'll give more than once. But what's up? We use a lot of Ned Davis charts because they do such a good job. But this chart, we had them look at what happens around the first Fed rate cut in a recession versus a no recession environment. This call, any call in the market from a macro perspective, is binary now. It's not gray. You've already had the slowdown. Either you drop further into recession or you recover. And there's a big difference in how the market reacts relative to whether you go into recession or not, as you can see here. And history shows that the initial Fed rate cut, you get in a no recession environment, you get a 24% gain. Whereas if you're in a recession, yes, it's positive, but it's mostly in the last 4 months. So from the last call, hopefully you guys remember that we did the 1995 analog where we thought that the environment, both politically, economically, monetarily, globally, news-driven, was very similar to 1995, and our bet was that you weren't going to go into a recession, and you were going to Powell was going to do what Greenspan did. Don't forget, in April of 1995, the Fed was still looking to raise rates twice that cycle. In July of 1995, they cut rates for the first time. Similar to the current environment, you had that pivot that nobody really expected that came from some pretty sharply slowing economic data. Remember, the Fed pivoted not after this last payroll report, but the one before it, meaning they started to indicate that you could have an actual flexibility on monetary policy after, I think it was, that would have been the May payroll report. So again, what got me to going on the chart before, on this chart and this chart, was there was kind of a bear narrative going around. They were showing you a 20-year chart of the initial Fed rate cut, and it happened right before a 40% drop in the last 2 cycles. That's true. There's nothing inaccurate about that. It's also incomplete. I'm a big fan of looking at all of history and not building a narrative around a certain piece of it. And, you had a market at 30 times earnings that it had a massive decline in the advanced decline line going into the first Fed rate cut in 1990. And again, you had the same thing, not the same thing. You had a financial crisis that hopefully will never be replayed globally in the banking system in the last cycle when you began cutting in 08. So, guys, it's just a very different environment. This chart is a hell of a spaghetti chart, as you can probably see. The point of it is when you look at that vertical dashed line, that's the first Fed rate cut outside of a U.S. recession. Right? What do you notice happens on that? You get a drop immediately. You rally into it a little bit, and then you get a drop. These are all the sectors, by the way. And then you kind of rip. And that's the story that we're telling here, is that not that I don't think the next, I wouldn't bet my ranch that the next tick is higher. I think it actually is probably going to have a little bit of choppy behavior around an overbought condition that has a little bit too much bullishness around. So I could see things getting choppy, but ultimately don't fight the Fed and don't fight the tape. So our whole core fundamental thesis revolves around inflation and inflation expectation driving Fed policy. That drives the yield curve, that drives the economy, that drives earnings, and that drives the market. There's a lot of people that talk about what drives the market. The thing that I find with the highest correlation, it's the direction of earnings, not the rate of change in earnings. And I'm working on a study right now that's very interesting, I think, which probably means nobody will read it. But it's interesting because the narrative is the out-year estimate is so high in the S&P that if it comes down like I think it will, who's going to pay more for lower earnings? And guess what? It doesn't correlate to the rate of change. It correlates to the direction of earnings, and that should remain positive. So what I'd like to do for the call, guys, rather than go through the whole slide deck, is really focus on inflation and how do you know whether it's a recession or not, given how the bond market's acting. So the Fed, even today, Powell's talking about inflation targeting. Their target's 2%. If you're trying to get to an average of 2% and you've only been there for a nanosecond this cycle, don't you think they're getting more worried about disinflation than inflation? There are two main things they look at are core PCE and inflation expectations. The core PCE has dropped precipitously down to 1.6%, right? It's hard to make the case that you're going to get an average of 2% when you're at 1.6% without doing something differently. And what helps them do something differently, meaning ease, is this implied 5-year inflation break even, which is at a 155, right? Which is suggesting 5 years from now, the market's pricing in inflation at 1.55%, pretty much where the current core level of inflation's at. So if these are your two key metrics that the Fed's watching, yeah, the economy's okay. Yeah, there's full employment. I get that side of their narrative. But the one thing that I'm sure they want to avoid more than anything else is being Japan. We've got too much debt. You cannot fix debt with exponentially more debt. So they have to keep doing this. And, that will bring up, the other side of the trade, which I'm very familiar with. The other side of the trade will say, well, that's just inflating the bubble. It's Fed induced. It's blah, blah, blah. Well, here's my response to that. Yeah. Okay. So what? Now what? The Fed has told you what they're going to do. I don't care if they're right or wrong. I know what they're going to do because they're telling us. If the guys printing the money are telling you they're going to keep printing the money, I could write all sorts of great think pieces about how they shouldn't that mean absolutely nothing to investing. Core inflation and inflation expectations continue to come down, right? It comes at a time when the only real worry has been about labor inflation. Labor inflation on the bottom half of this slide, page 7 that you're looking at, that's productivity, U.S. productivity output per hour. If you're worried about labor inflation, it's hard to get high labor inflation when you have high productivity, right? Because look at what drives productivity, unit labor cost, or productivity drives unit labor cost. Unit labor costs are coming down hard. So if unit labor costs are coming down hard and core PCE follows that, It's hard to make the case in any way that inflation is about to have a significant uptick. I think they're more worried about disinflation than inflation. And how much should they ease? You got the 10-year at 202 this morning. On this chart, it's at 201. It's at 202. The 10-year is below the lower bound of Fed funds. You don't need to be a Nobel economist to figure out something's amiss. So herein is where I will differentiate versus my competition. I'm on everybody's same, we're all on the same page. Economic growth is decelerating sharply. That's been the story from some for not expecting upside market. As you know from the last time we were on, that is the bull story because it allows the Fed room to ease. The market is commanding them to ease more aggressively than people think. This chart here is the heralded 210 yield curve. I love to actually check and see if I'm full of it. So I went back and I looked at early 2006, the first week of 2006. I did a Mythbuster piece on the yield curve, and I used the 210 curve. So the 210 curve is what drives shadow banking. Shadow banking is what drives most of the growth in credit right now. So that's the one you need to invert. And actually today, after Powell's comment on Capitol Hill, it's actually bounced up to over 20 basis points. So it's a pretty interesting day because you're getting a re-steepening of the yield curve, which is constructive. Guys, don't forget, your median gain in the S&P is 21% over 18 and a half months. After it's inverted, it has yet to invert. I get it. The 3-month and 10-year has. I talked to the head of a bank and I asked him if he cares about the 3-month, 10-year because that's what the Fed says banks worry about. He actually said I couldn't care less. So, it's based on LIBOR versus effective Fed funds, which frankly is inverted right now. So that's why the Fed has caught their attention more than the 3-month, 10-year. But bottom line is the 210 has yet to invert. Banks are still willing to lend. This is lending standards for large and small businesses. And, so here's where we differentiate. The Treasury market is telling you, because the 10 years below the Fed funds, lower bound range, people would suggest that the Treasury market is telling you a recession is coming. That makes sense to me, right? Because you had a drop from 3.25 to under the Fed funds rate. That kind of makes sense, right? The only problem is that recessions don't just come from the Treasury market. They come from all areas of credit. So what you need is a confirmation that the drop in Treasury yields is happening at the same time as a significant worsening in non-Treasury credit conditions, right? I just showed you the bank lending. They're still willing to lend. This is the LQD, which measures the 10 years on the top, and the investment grade ETF, the Barclays investment grade ETF, is on the bottom. Actually, that's not true. This is the high yield total return index is making a new high almost every day, right? So when you look at that against this next slide, which is the bottom half of this is high yield spreads against 10-year treasuries. With the 10-year treasuries going from 3.25 to 2, you've still narrowed the yield curve or the corporate spreads because there's been a rally in the high yield corporate bond market. This is the chart to focus on when people say the bond market is telling you something with treasuries. You got to define which bond market. This is the corporate yield, right? You cannot find a time where you've had a massive recession or any recession when the corporate yields were coming down. High yield debt, what creates the widening is you get a flight to safety in the treasuries and a massive selling in corporates. And then let's say everything I've said is different this time because of the zero interest rate policy or the lower risk premium and all that other fun stuff. So this is my checks and balances. This is the National Financial Conditions subindices from the Chicago Fed. All right, this is basically telling you that there's no stress being priced into credit. These 3 spaghetti lines measure 105 indicators in credit stress, right? Typically, even if you look back at 95, it was way worse than this. And a couple of them. The truth is you're near a cycle and historic low, the lowest level in decades for the risk parameter on this. It's hard to have a recession if there's no credit stress. It's a credit-driven economy. And this is just technical analysis of fundamental data. No matter how you slice that, that's a downtrend. But because it's, credit and everybody worries about the bubble, they'd say that credit's going to be stressed, which has been the case since 2012. More people have been saying that. So here, what I think is happening economically is if you look on this chart, the blue histogram is the real GDP, quarterly annualized GDP. When you look at the right side, there's been no recession in 10 years. We know that. What I want to do is point you to the left side. When you look at that blue histogram from 1949 to 1960, you had 4 recessions. The market went up nearly 400% during that period. 4 recessions, all had basically your median decline for those 4 recessions in the S&P was 21%. Okay, seems pretty normal, right? I would posit to you that we've had 3 recessions this cycle that aren't official recessions, but pretty damn close, associated with near 20% drop. You had the 2011-12 European debt crisis, which had a 19.6% drop in the S&P 500. Call me crazy. I'm going to call that 20% because the TV doesn't want to actually mark it as a bear market, whatever. 19.6 is 20. 2015-16, we all know about the internal bear market in that industrial global recession when oil prices collapsed from 125 to 26. We remember that. That was clearly a global commodity crisis driven semi-recession. And then you've got, most recently, you got the current time where the global PMIs and all the various commodities and everything else has been under pressure, I think. Plus you had a 19.8% drop in by December of last year. Call me crazy again. What if we're actually 6 months into a new bull market versus being 10 years into a bull market? That would kind of shake up what expectations are. And how do you know if that's true or not? Because you got a volume thrust that Tom McClellan did a good job. So many people did a good job of identifying, including us, frankly, in February, where you got this breadth thrust off the low that is usually indicative of forward gains not being at the end of a cycle. Couple that with my friends at the Lowry Service, which they put out great stuff on operating company only AD lines and all the other fun stuff that we like to look at. I can't find anything that's not confirming the recent new highs in the S&P 500. And people would say, but the trannies and transportations and the transportation stocks and the small cap stocks are underperforming. Exactly what happened in 1995. And if you look at the transportation stocks, pull up a chart of transportation stocks against the S&P, they also significantly underperformed the new high in both twice already this cycle. I think it was 2012 and 2017, or 2016 or 17. But just look at a chart, you'll see it. All right, small business optimism remains high. It's kind of churning around, waiting to find out what we do with the trade war. Consumer confidence is coming off peak, also waiting kind of to see what's going on with the trade war. We still have the demographic tailwind. The millennial demographic is turning 30 in 1990 or in 2020. They've had 10 years of employment, 10 years of market gains, 10 years of income verification. They can buy a house. That is beginning to happen as your home ownership rate on the bottom is trending higher, as your homeowner vacancy rate is trending lower. So, we're in this situation where we think there's a fundamental story that could be made. Yes, there's been this massive slowdown since the peak in the global economy since the peak of 2017 in November. Well, we think that the lower interest rate regime of the last 6 months is going to turn it the other way as we move into next year, and that we've already been in a mini recession. This is the unemployment rate still at a generational low. It's hard to have, this chart is household debt service ratio. It's hard to have a household credit crisis if you could still afford your debt. People love to talk about higher rates. They always forget to talk about the higher incomes and the jobless and the job activity that allows you to afford more debt. Okay, so quickly just want to point to a couple of slides. On the global economy, this is the breadth of the purchasing managers indices globally, and it's the share of the PMIs showing positive year-to-year changes. We're bouncing. We've been kind of bouncing off the low, just like we inflected from the peak at the end of 2017. We're doing the opposite today. So the share of the PMI new exports orders posting positive year-to-year changes. I am not telling you the global economy is good. It is not. I'm telling you that you're seeing signs of an inflection off of a very low level. That's confirmed by the OECD composite leading indicators, which suggest that so that blue line, which is what everybody talks about, this measures 36 economies globally. It's the oldest data series you could get in composite leading indicators for global economies. That blue line is near a historic low. What I'm pointing to is the black line, which is the month-to-month change, is what drives the year-to-year change on the red line, which ultimately drives the blue line, and you can see that they're all inflecting. So the narrative that I would use is where I've been wrong this cycle is I've underestimated the hit that the market takes on what these little mini recessions or soft recessions that don't get declared, the impact that they have on the markets. I'll try not to make that mistake the next time rates go up again, because it'll do the same thing. And, when you think about how rates affect the economy today and why we haven't had a more important recession, think about it as bumper bowling. Most people know what bumper bowling is, right? Bumper bowling, higher rates, maybe 3.25% in the 10-year, it backs you down, slows the economy down. That's the left bumper. And on the right bumper of the bumper bowling, you got 2% or under in the 10-year, which picks activity in the refi and housing market up. So we're kind of in this period where the amount of debt has created a soft gain and a soft landing each time when it gets to an extreme. I don't know if that makes any sense, but that's what we're kind of seeing globally. Earnings, we're going into earnings season. The current expectations are for Q2 19, according to IBIS from Refinitiv. You're expecting consensus expectations for a drop of 0.1%. What I like to remember is that this cycle, from the beginning of the quarterly earnings season, which would be obviously July 1, it really kicks off next week with the big banks. You get a median 3.5% gain. You've never not had a gain this cycle in the estimate for earnings from the beginning to the end of reporting season. So if you take the median, we're probably going to be closer to 4% than 0 when it comes to earnings growth. Certainly we should, it would be historically unique to be negative. So one more slide before I open it up. Okay, this is our call for next year is for S&P. Frankly, our call this year was 29.50. We hit it, obviously. Rather than trying, just make a 6-month guess on valuation, which doesn't work. It's just a guess. We're focused on our next year target of 33.50, which is based on a 19 multiple and 176 in earnings. I say a 19 multiple because that's historically what the market multiple trades at when core inflation is between 1% and 3%. We don't have to go to a long history to find that. We just have to look at 2016 through 2018, where your average multiple was 19 times. So we're at 19 times, 176, 33.50, and we would buy weakness until rates go significantly higher.
Wow, you need a break.
Yeah, that was fast. I'm sorry about that, guys.
No. It was awesome. It was an excellent presentation. There are a couple questions in the room, so I thought I'd pass those on to you.
Please.
One, how do you measure productivity?
It's output per unit of labor, which is put out by the government.
Okay. Next question, how does the growing national debt affect the Fed's maneuvering with interest rates? The Fed funds rate. When you look at growing national debt, I think you talked about that earlier, the debt keeps growing and growing.
Yep.
At what point is it a problem for you? Is there a signal that triggers, and what's the impact on interest rates?
So the national debt has been a reason for people to be bearish since I got into this business in May of 1987. That was what made Greenspan so concerned about inflation, because if rates go significantly higher, you're not going to be able to afford the interest payments on that debt. We're all familiar with the chart of interest payments to debt by the government, and it's kind of been a flat line at a very historically low level, but the dotted lines of where it's going to be is always up and to the right, because there's this assumption that there's going to be this huge inflation uptick because of the liquidity that's going to cause interest rates to go nuts and not able to afford the debt, right? That's the narrative. The problem is the amount of debt, and as soon as those interest rates go up, it slows the economy down to limit inflationary pressures. So it's actually counterintuitive, where the increase in the level of debt has caused less inflation naturally, because you can't get the kind of growth rate you need because you can't afford the interest expense.
Okay. Makes sense. All right. Well, those were the two questions out of the room. I could keep you on here for an hour. I got a lot of questions, but I know you got to go. And
yeah, don't do that.
Yeah, I'm not going to do that to you. You mentioned Marty Zweig earlier, and
Yep.
Do you know the name Norman Fosbeck?
Yep.
Big historian in the market.
Yep.
Okay. Well, I've followed the history of the S&P 500. I go back to 1950. I've got a daily spreadsheet. I mean, it's like the spreadsheet of all spreadsheets. But you mentioned, that you thought that perhaps we could have a little pullback, and I was just wondering if you were aware that from July 17th at the close through September 27th at the close, the S&P 500 over those days since 1950, and we're talking about like 3,500 trading days. If you go back, you take those 2 months and 10 days and go back 70 years.
Yeah.
That period has produced an annualized return of minus 2.16%. You might think, well, that's not really much, but when the S&P is averaged going up about 9% a year for those 70 years, that's 11 percentage points of underperformance during the summer. Do you pay attention at all to the seasonal patterns like that?
I don't, because active managers aren't driving it.
Okay.
Like if you look at the last 10 years, so if you do, exponential versus simple moving average, right?
Yep.
You look at the most recent data, there's nothing to really support that claim. Now, you obviously May was a bad month, but now turn around June and July, not. And I wrote a piece last year called "Sell in May and Go Away," and it was not. So what drove that historically was active managers moving the market. The millennials who are in the target date funds that are putting all their money in indices from that, they don't care what time of year it is. It just happens and happens and happens. So I think passive has affected that to some degree, and it's been a lot more random recently.
Okay. Well, I'm not a fan of go away in May, and I've talked a lot about that. I know small caps, Russell 2000 in particular, tend to do very well in the month of May and June historically, and so that would be one reason for sure to dispute it. But yeah, I'm not a fan of that. But I just found it interesting because I look at July 17th to September 27th. A lot of folks on vacation. I just think that maybe less volume. There's a little bit more manipulation. But I was curious whether or not you had any thoughts on that.
You want to hear kind of an interesting off the top of my head thought?
Sure.
We're at a new record high at 3,000 on the S&P today, right?
Yep.
You know what that means? You should have never sold in the history of the market.
All right.
So the only times you really, in my opinion, should get very negative is when you can prove to yourself that there's some driver that will take it down really hard. And that driver has to be an inversion of the 210 curve that shuts down the shadow bankers and causes companies to not have access to money. And that's when you get these massive drawdowns. But other than that, for the individual investor, it's really, it's where you're more aggressive as a buyer, not where you should be a seller. Historically, it's just by definition of a new record high.
Yeah, and I would go a step further and say, please, everybody listening to the show, please don't let the media be your driver.
Yeah, for sure. Even though I'm in it, I have a very hard time with it.
Well, I meant except you, Tony.
Well, no, it drove me bananas yesterday when I'm listening to everybody talk about how the slowing earnings growth is this year and next year is going to cause the market to go down. I wish they would do the research just this cycle. 2013 and 2017, guess what happened? The market expectations for earnings tanked. They tanked.
Mm-hmm.
I think it was over 10% both years. They were up 30% and 20% respectively, and you had a multiple expansion for both of them because interest rates had come down.
Mm-hmm.
So the media, just be, I always say to people, find the people you like. That's nice. Even me, discount me. All right. Everybody's got a bias. Discount everybody and do your work. And if somebody says something, check it.
Yep. Agreed. Totally.
That was my rant of the day.
All right, I'm going to pull up a couple charts real quick and get your thoughts on this. Now, this doesn't go back nearly as far as you've gone back, but what I did do is break down the current bull market, assuming that we talk about 2009 being the bottom and this a continuing bull market. These are a couple of charts I wanted to show you. So transports versus utilities. This is the direction of transports versus utilities. And you can see when transports are leading utilities throughout this bull market, that is when the S&P 500 makes its big move. When utilities are leading, we tend to see more sideways action in the S&P 500. So we have been going down in this ratio for the last 18 months. And if you look back to the last two periods where we've had transports underperforming for 18 months, we've come rallying out of that, and that has triggered a big rise in the S&P 500.
Yeah, it's a great chart.
What was that?
That's a great chart.
Yeah, I mean, I agree. I think it is a really good chart. And, you know, when we look back, we've had a lot of ups and downs for the last 18 months, but part of it has been, you know, the 10-year Treasury yield has been moving lower. That favors utilities, not so much the transports. And as a result, that, you know, triggers this downtrend. But my feeling is that now the Fed has kind of finally gotten behind what's going on in the market. They've changed their tune, as you suggested back in April that they do. And I think we got a much better picture going forward. I mean, maybe I'll be wrong. Like you said, you discount everyone, but I definitely have a bullish bias.
Hey, could I ask you a favor?
Sure.
Could you pull up the chart of the trannies, not as a relative performance against the Dow, but just the two charts?
Just the transports?
Transports. Okay. So now can you put on there the S&P as well? I don't want to see a relative chart. I just want to see both of them.
All right.
Okay.
How's that?
So you see, can you do, how far back does that go? Can you go back 5 years?
Sure. I'll do a 5-year weekly.
Yep. Or 10-year weekly is even better.
All right. We'll do 10-year weekly. All right.
Okay. So when you see, what you see here is in 2013, you see how the trannies ripped at the end of 2013?
Yes.
You were already at a new high in the S&P 500.
Yep.
You had made a new high in the S&P 500 in October of 2013 as the transportations were still kind of actually rolling over and looking like they were trending lower, right?
Mm-hmm.
And wasn't that true again in July of 2016?
Yep.
Right? So you were coming out of these two, what I phrased as like almost semi-recessions, like soft recessions that weren't declared. It's the same kind of behavior. Transportations are acting poorly, even though the market's making new high. And in both of those occurrences, people were calling for poor performance in the transportations as a sign that the market was going to go down. In the meantime, the new high was confirmed later. It's like the whole negative divergences only work in hindsight because you still have, it can still catch up, I guess is the way to phrase it.
Yeah, and I think too, you know, transports did rip higher. You go through a period of consolidation, they rip higher. You go through a period of consolidation. I still see an uptrend in play on the transports in the long term. And when they do go through these periods of sideways consolidation, that's when the S&P 500, you can see, has historically struggled. When that would be a good sign, I think, for everybody out there. When if you see the transports start to move, I think that would be a really positive sign. And railroads are already strong. It really comes down to the truckers more, in my opinion. I haven't really seen too much.
And FedEx.
Yeah. Yep. All right. One final on it. I probably should get going, but I really, this is exciting. I want you to have one more thought, because money, obviously new money comes in, but then there's also the rotation, the allocation strategies that many portfolio managers use. And so one thing that I also noticed is during some of these same periods that we just looked at, when the market believes that the economy is beginning to strengthen or even anticipates it, we do see money rotate out of Treasury, sending the yield higher, the 10-year Treasury yield. And during periods when the 10-year Treasury yield is on a roll to the upside, we also have seen massive moves higher in the S&P, which to me makes common sense because money is just simply rotating from one market to another. When the yield is going down, like we've seen for the last 9 months, that's when the S&P 500 tends to really struggle to move higher. Any thoughts on this before we wrap up?
Yep, that just confirms what we're talking about. But in each case, before the market really took those rips, you were starting it from a new high.
Yes. Yep.
Similar to like right now, you've just barely made a new high. Look at how you barely made a new high after July of 16, right? Barely made a new high. Looked even like it was rolling over.
Yep.
And then you got your monster gain, right?
Absolutely.
Same thing was true in 2013. Basically, what you're saying is you put on a mini recession trade and you're now about to take it off.
All right. Well, this was another great session. Really enjoy having you in here, Tony. I hope you'll be able to come back and join us pretty soon. Maybe more often than once a quarter. Great insight.
All right. Have a great day. Thanks for the opportunity, guys.
All right. And one last plug. Where do people go if they want to follow what you do?
DwyerStrategy.com, where you get the vast majority of what I put out to the institutional guys. It is hopefully you like it. We're still working on it, but it's I'm told pretty inexpensive, and hopefully you find some value there.
All right. Appreciate it. Thanks so much for joining us today, and have a great rest of your week.
All right. Thanks for the plug. Have a great day, guys.
All right. Thanks.
All right.
Tony.
Excellent presentation. My goodness, the chat room was pretty chatty.
Yeah, it was a great presentation. I told everybody, look forward to this one. I really enjoy when you get a lot of backing up of data. I'm not a real big fan of having someone just come on and just make a bold statement that the S&P 500 will be down 30% next year. I mean, point something out in history and support your opinion. That to me really, when I talked about the media earlier, that's what I meant. Certainly anybody who's in the media and comes out and has a very strategic call to make and has the reasoning and the backup, yeah, I want to listen to that all day long.
Yeah, and I really like it when we get some of our guests, and especially Tony. He looks at fundamental, issues and that sort of thing. But he does it. He technically analyzes it, so it's not just throwing some data out there. He's really analyzing it in our technical analysis world.
Yep. All right. Well, what do you got there on the RRG?
Well, we have a big time outlier going on here, so we will look at that one for sure. And then if we come back in here, everybody's pretty much traveling right there with the S&P relatively. But as far as the sectors go, technology and healthcare, the big leaders. So let's go ahead and start off with smart. What was that? Smart sheet. Yes, I keep wanting to say screen.
Now this one looks really good. Great move up off that June low. That's when the S&P started rolling. And look at the volume coming in. This is really important in my analysis. Not everybody looks at volume, but I think it's really important because I think it tells us about accumulation or distribution. And when you see a stock going straight up like this with that kind of volume and outperforming a very strong software group, its peers have been very strong, and this one's breaking out to a new 52-week high, it's hard not to like it. I think it's a great stock.
All right, let's look at an ETF, the biotech ETF, XBI.
Oh, actually, that's right. Don't need the relative chart for this one. XBI is definitely performing better. I like the uptrend here that you can see off the bottom at the end of May. I like the fact that we're bouncing off this 20-day. We went a little bit below it at the end of June, came right back up. A couple of days ago, closed on the 20, opened below it, came right back up. So and July historically is a good month for the biotech group. So we opened the month strong, came back. We're now about even with where we ended June. I think we're going to go higher here. Maybe it's just that history bias that I have, but I think the biotechs look good.
All right, looks good. The other most popular in the room was ViewRay.
All right, ViewRay, that's a medical stock. Yeah, I think so far holding up pretty nicely relative to its recent lows, bouncing today. I'm going to go into that relative chart. And now this one doesn't have the information, so let's stick with that daily chart. All right, so on the daily chart, obviously we want to try to get above that 920, 925 area. So as far as annotating, there is your resistance. But I think the key area of support is going to be down around 820. That's where you can see we pulled back, printed a hammer, came back down, held this low. Here we got close, holding at the 50-day moving average. But I would say roughly 820 to 920 is your range. But we got a nice uptrend in play. So I suspect that this PPO is going to start to turn back up. Beautiful day today. breakout above 925 is what you're looking for.
All right. And on this one, can you say parabolic, at least in my opinion? Pay sign, Pays.
Yeah, I mean, it's definitely, moving higher. I think on a chart, if you're using a log scale like I use, it might not show as much. If you're using an arithmetic scale, it's probably going to show much more of a parabolic. But yeah, I mean, the stock is being supported. There's probably a lot of traders on here. It's going to be extremely volatile. I don't see anything yet that suggests that we have a top in play, but I would simply watch the 20-day rising 20-day moving average as an opportunity for entry. Check out that hammer right there. If I see a stock like this, heavy volume breaking out, coming down, going below the 20, when it comes back up above the 20, if I see that, I would be a buyer. So I would just continue to watch. I wouldn't chase it because I do think this is a stock that could easily fall 15% in a very short period of time, a day or two, just because of the upside. So I'd wait. But yeah, 20-day moving average, I think would look good for me.
Yeah, absolutely. I think the stock still looks good, but yeah, I'd have a trailing stop for sure. Let's see. How about Fortinet, FTNT?
I saw that was on a scooter mover yesterday when it broke back here above the 50. It is starting to show some strength, but it is in a very, very strong area of the market, software, where it has been a big laggard. So I have to see some signs of relative strength. Right now it's rising, but so is software. So it's really not getting, it's not scraping itself up off the bottom of the barrel just yet. I'd have to at least see a break there and then maybe get through this gap resistance here where we had gap down on some increasing volume right here on this big red candle. Let's get back up above that level. And you got a lot of gaps to fill here. I think this one's still got a lot of work to do. I prefer other software still.
All right. From Com Services, T-Mobile, TMUS. Just got a PMO buy signal.
Yeah, this one talked about the open of the show, but they did come out and announce that they're being added to the S&P 500. So obviously, there are going to be a lot of funds that are going to have to buy the stock. And you can see the heavy volume to support that theory. It's really not a theory, it's actual. But we're in a trading range 72 to 80. I think eventually we're going to make the breakout. I have been a little concerned about the mobile telecommunications group because of this relative weakness here. But at least with T-Mobile, you're getting one of the stronger stocks. It's breaking out on a relative basis.
All right. What do you think of Penske Automotive, PAG?
All right, PAG. I think this one is on my strong earnings chart list, or maybe it's just one that I talked about recently. I think actually this is one that came up on a show with Mary Ellen. It's in the specialty retail group, and I do really like this group. But there was a breakout that couldn't hold. Now it's trying to hold on to its rising 20-day moving average. This is my problem with the stock and why I would be real careful with it. The group is making a breakout to an all-time high, and yet we have been in this slide on a relative basis for nearly a year. And I mean, there's just nothing that would tell me that this is the one I want to own within specialty retail. I think there's way too many other great stocks. We got this price breakout. You think, okay, that's the catalyst, and we go right back down below it. So it's not going to be one of my favorites. I'd look elsewhere in the group.
All right. We have a pharmaceutical, Minerva Neurosciences, NERV. Oh, I'm sorry. N as in Nancy.
All right. NERV. Huge move up, came all the way back down to the 20-day. And this is why you want to be careful on some of these pharmas and biotechs when they get news and they gap up. You got to be real careful. This is where you usually get a lot of massive black candles, which means you gap up on the open and then you close way below. Look at that volume. That led to a little bit of short-term selling, but then it's come, moving quite a bit higher and back. This is just a stock that's been under pressure on a relative basis for a while. So I would view it right now as there are a couple of levels of resistance right there, intraday high and net open, and to the downside, that low right at the 20-day. It's a wide range, but you're in a pretty small pharma here. I would be careful with it. I think it's in the middle of the range right now. Not sure which way it goes. Not my kind of stock, though.
All right. For our friends in Canada, Maxar Technologies, MAXR.TO.
All right, .TO. Yeah, this was one that I mentioned, not the .to, but just MAXR was one I mentioned as a scooter mover just a couple of days ago. So let's pull this up and take a look. I think that it is coming back down to test the breakout level. The breakout level and the rising 20-day moving average would be the two key areas that I would focus on as major support. Right now, it's trying to turn at that price support area, which I find pretty bullish. I like the stock. Actually, got up over 13. Now it's back down 11.95. If I were getting into it, I'd probably build half a position at the current price, another half if it gets down to that 20-day moving average. My initial target would be 13, but this is a stock that looks pretty good with good volume trends. I think eventually we make that breakout.
All right, and our last one, Career Education Corp, CECO.
All right, CECO, breakout, pullback, holding this low. So, yeah, this is one that I still am okay with. I would be watching right there. You see this low after we put in the cup, came down, put in a little handle at the 20-day, held that, went higher, and now I've come back and held that low. I think this 18.25 area is really important. Upside, maybe just over 20. That's your trading range. We're sitting in the middle of it. I wouldn't do anything now, but it is this sideways consolidation is off a very nice uptrend. I expect we'll see a breakout rather than a breakdown.
All right, next one up. Well, there are no more, so it is time to move along. Here are the ones that Tom did just annotate, and they will be up in the MarketWatchers Live chart list after the show. Just go to the MarketWatchers Live blog, click on the live link at the top, and there you will have them. All right, we'll be back with the final market update after this.
Today's market volatility provides savvy traders and active investors with an abundance of profitable opportunities. At the Traders Expo Chicago, July 21st through 23rd, dozens of the most respected traders in the world, including Rick Santelli, John Najarian, Tom Sosnoff, Linda Rashke, and Ralph Akampora, will explain how they're adapting their strategies and share the specific trading opportunities they've identified in equities, commodities, forex, futures, and cryptocurrencies. Claim your free pass to join them at chicagotradersexpo.com.
First. All right, we are here with our final market update. I wanted to look at our sector summary right now. I think it's pretty interesting. We're seeing energy as our leader. It is up over 1% currently. Finance is the only negative sector, down 0.05%. And just a quick look at our market overview here. Dow is up about 0.35%. NASDAQ certainly having a pretty good day, and the leader amongst those indexes up 0.69%. And the Russell 2000 also up a little over 6 points. And that's all I have for our final market update.
All right. I want to just point out on the S&P 500, earlier we did see that move up over that 3,000 level, got to 3,002.98. We did have that prior high of 29.95, and currently we're at 29.94. So we're just below that level. If we finish below 29.95, I would view it maybe as a short-term negative since we had that breakout, couldn't hold it. But the PPO, the daily PPO, still remains strong in my opinion. So if we were to pull back, I think the key area of resistance, and I'm going to annotate this just very quickly, I think that if we were to pull back, I would expect that we're probably going to hold that 29.50 area. The rising 20-day moving average, which has not even been tested since we broke above it back in first week of June. I think if we did show a little bit of weakness, it might come back down to this 29.50 area. I know earlier Tony Dwyer was indicating that, hey, when you get that first cut or the thoughts of that cut, we might get a little bit of a pullback initially, and then we start to rip a little bit higher. I wouldn't be surprised to see a 29.50. Honestly, I think possibly we could even go a little bit lower over the summer months, but I do think we go higher. And if we get this breakout today, and we actually close today over 3,000, I would expect to see more buyers jumping in here in the short term. So that is all I had. It is time now for a scooter report. And Erin, I'm going to let you take it away. What do you have for today?
All right. I just thought I'd go through the technical rankings today, which ones are the big top movers right now. I use my candle glance right here to be able to look at it and get a really good feel for what's going on. These are the ones I have on a really short-term chart. You can see we're getting some nice movement here to the upside on pretty much all of these as their scooters are moving to the upside. I thought that Constellation Brands, though, looked especially good when I was reviewing it. You had the PMO on a buy signal. We are having a little issue getting over this hump right here, just above $200. But you can see even in the candle glance, I'm sorry, the thumbnail, that we do have an ascending triangle. And I think that looks pretty good to me. I'm going to move over here and we're going to go back to the dashboard. That way I can get the candle glance that I'm most comfortable with. And here we go. I'm going to look at the scooters now for the mid cap top up. And again, I can go in here and use my candle glance and get a feel for which ones look interesting to me. And when I was looking at it before, I thought this one looked pretty interesting. It is a pretty low volume stock, but look at that nice breakout from that declining tops trend line. And the PMO is right there, confirming this breakout with the PMO buy signal. Now we'll go back now and we'll look at these small cap scooter movers. And right here. All right, top up. And I'm going to do that candle glance again. And here you go. A couple of really outliers, some really big moves to the upside in the small caps, but they do tend to be just a little bit more volatile typically. The one that caught my eye right here was Cadmon, KDMN. And the reason being, we're now getting a PMO that is in positive territory. And look at that nice move on the scooter. Breakout in the short term above $2.30, making its way toward that 200-day EMA. I'm thinking we might see that breakout this time around. That's all I had for my scooter report. What you got going?
All right. I thought for today what I would do is I'm keeping track of these scooter movers of the day that we've had. We started doing that probably a little over a week ago. And so I thought I would just kind of go back and see what they're doing, a few days or maybe a week later. So the first one that we featured a little over a week ago was MYOK, Myocardia. And you can see the huge move that was made in the scooter score. I had some, little trepidation with this one because even though it was making a move, we did have a downtrend. We had some overhead price resistance to try to get through. You can see that the relative strength wasn't exactly great. But the volume coming in was pretty good. So it was worth keeping an eye on. When we did make this breakout, and I was looking right around 50 and a half, 51, and we got that breakout, look down here at the volume. Volume was almost non-existent, one of the lightest days of the year, and we didn't hold up, coming back down, but so far holding the moving averages. So I don't know that this picture really has cleared up just yet on the chart technically. If we could get some volume coming back in and get a breakout above about 51 and a half, I think that would start to paint a little bit more bullish picture on this move to the upside. I know that Greg Schnell does a lot of work with the scooters. He likes to look at the 75 level as being the hot zone when you get above 75. Notice MYOK got up to about 70 and turned back down. So it's just kind of right in the middle of the pack right now. Needs to do a little bit more work. Nectar Therapeutics, another one that had been in a downtrend. And look at the relative strength, had been absolutely horrible. But volume came in. We've trying to, hold this double bottom, moving back. The trend line had been broken. The problem I'm seeing at this point is we still are not moving to new highs. And you can see the scooter, which had jumped, is now pulled all the way back down and is back in single digits. So this one's still got a little bit more work to do as well. Valhai, VHI, huge move up in the scooter. Then we started coming back down, though, in the scooter. And I know there was one stock that I actually talked about it was a scooter mover to the downside. This one might have been it. And I think when I talked about it, I said, well, 270, we want to watch that price support level and that 20-day moving average. And right now, that is exactly where we are trapped between the two of those. So if we can hold here, get this breakout back up above 270 and ultimately $3, then I think you'll see that scooter jump. If for those who are really interested in a flyer, and looking to maximize reward to risk, it is at that 20-day moving average right now. But just keep in mind that it is in the very volatile area. Well, it's a very volatile stock, I should say, and it has not been a very good performer relative to its peers. So I would keep my stop very tight. Just a couple more. MAXR, I mentioned this one earlier, talked about it, MAXR.TO. Same thing, pulling back to the support level. Not really much more to mention there. And then Micron yesterday was the stock we showed, the breakout there above 16. The scooter for the first time breaking above 50. Well, first time in 3 months. So we're getting into the top half. And now this one is, when you look at the rate of change, look at that short-term rate of change turning back to the upside, volume coming in on that break, holding that 20-day moving average on the last test. So I think MTSI is one that actually starting to show a lot of strength. Breakout above 17, I think would really begin to confirm the strength that this one is beginning to show. All right, that is it for our scooter movers for today. You can see what we covered, and we are now going to move into our final segment of the day, which is chart breakouts. And I think this is pretty timely with the S&P 500 moving above 3,000 earlier today for the first time in history. What chart breakouts do you have today, Erin?
Oh, I know. It was very interesting. I wanted to point out. So these were the 5 that, actually 6 that caught my eye. And I thought it was interesting that 3 of them were from the utilities sector, especially when I looked at my sector summary. And utilities, I mean, having a good day. But I would have expected, when I scanned, to get more from these top 2 sectors. So thought that was interesting, but some great looking charts there. So I'm going to actually start here with Charter Communications. And I like that breakout right now. I'm going to annotate this just so we have a good look at it. Annotations don't want to work right now. No big. All right. So we do have that nice breakout going on there. Look at the PMO, just having that buy signal on the breakout. And this one, Charter, has been in the hot zone for quite some time here, actually since about April. So I like that nice rising trend. Can't get much better than that. The next one was Cryoport. And this one, it wasn't so much that it's breaking out necessarily today, but it has been breaking out. And I like to see that along with the PMO that is getting ready to have that crossover. But look at the volume here. Lots of interest on this stock. So I'm very much liking Cryoport. Globant was the one that actually caught my eye first when I looked at my scan results, and I had about 25 of them. So this was the one that just really caught my eye, mainly because of that really nice breakout and the fact that it has been in this rising trend, since December. You've seen some of these other charts where we have a lot of work to do, comes back down, moving mostly sideways, but this has been really in a nice uptrend, holding that 20-day EMA. It tested a little bit, fell below, but the 50 is holding beautifully. I thought this one looked really good as a chart breakout today. Alliant Energy, and this is a utility. We have that PMO getting ready to have that buy signal. And then you can see right there, and let's see if this is going to cooperate with me today. It's working earlier. There we are. So there you have that nice little breakout. It's just a tiny one, but I think it is promising when it is accompanied by a PMO that's looking very healthy. And you can see the rising bottoms on the PMO, so that's all good. Let's see, the next one I'm going to look at, and full disclosure on this one, I do own it and have owned it since March or so. It's been obviously it's been a great hold. I'm very happy with it, but we're now seeing a breakout here. I did question a little bit when I got this PMO top and we hadn't even gotten to overbought territory, but I'm more of an intermediate term trader. It didn't look, there wasn't enough internal weakness or even relative weakness there. You can see that it's been very high there on that scooter. So, I like it and I'm continuing to hold it. And I don't think you'd be chasing it right now. I think that it still has some more room to go on the upside. And then finally, last one, WEC Energy here. And this one, you are also getting a little tiny breakout, but a breakout nonetheless. And you can see that the PMO has been already switching and moving to the upside. And in the thumbnail, it's a lot more apparent. You can see the rising bottoms on this OBV, and it's matching up very nicely with the price bottoms that are rising. And there you go. The scooter is now just moving into that hot zone. So I know utilities, as we say, aren't necessarily like the sexiest place to be investing, but I'll tell you what, I had, like I said, I have Southern, and I can't remember the other one I have, but they've really been consistent performers for me.
All right. Well, I am going to add a few more to your list, and I'm going to start with the top performer in the Dow so far today, Cisco. Talked about Cisco recently. They did just buy Acacia Communications yesterday for $26 billion in cash. I wrote about this a little bit in my blog this morning. I think that this is a really bullish looking chart. I think the fact that they're going to be able to add some earnings they're going to be able to add some earnings to their current earnings, I think is bullish, just another bullish confirmation, if you will. But this isn't a stock that has been uptrending here now for the last week or so, a little over a week, and threatening to break out of what I see as an ascending triangle. Equal highs have been 57. We're at 57.27 right now. If we fail, we come back close below 57 today, I'm still going to be bullish the stock. But I think you have to be prepared in the short term, maybe for a little bit of weakness. But if we get this breakout today, I think this will start a big move to the upside on Cisco. So I certainly would be keeping a very close eye on this one. AMD, full disclosure, I own Advanced Micro Devices. It is making a breakout on a closing basis. It did that, almost did that yesterday. You can see we had closed, let's see what the closing price is here. The closing price back on June 10th was $33.23. And yesterday we closed at 33.15. So we almost closed higher yesterday, but today we are making that breakout. And what I find very encouraging is the volume coming in. We are just a little past the halfway point of the day. The volume has continued to accelerate as the stock has been rising. I know I've talked about AMD quite a bit on this show. I'm a big fan. I think this stock on a relative basis is beginning to show leadership again, which I think also is something to keep in mind. Look at the relative strength building on Advanced Micro versus the semis. So this is a stock that not only is breaking out, but I think looks very strong relative to its peers. Oracle. Now this one I've got to kind of eat a little bit of crow on, because I know when they came out with earnings, or maybe before they came out with earnings, I talked about this one being such a huge laggard versus the versus the S&P, and then also versus software. But they came out with their earnings, and that kind of was a game changer for Oracle as you look back. Beautiful move up. We held that area of support the next few days, and look at the volume as we keep moving up. And now all of a sudden, the relative strength on Oracle has really turned back to the upside. So I've kind of changed my opinion on this one. I think this breakout 52-week high earnings report that was stronger than expected has changed the fortunes here on Oracle. Disney, stock that I really like. I think the equal highs coming across here, 141, 142. Maybe 142.5 there. We need to clear that on a definitive basis with some volume, but look at the relative strength. Really strong stock, has been for a while. I think this is one that certainly can hold on to. I really like Disney at this point. Viva, VEV, Viva Systems, been one of the best software stocks. We talk so much about software, but the volume is not letting up. When we go through these big moves to the upside, the volume has been strong. Now, last few days, volume has kind of weakened a little bit. This candle, and I'm going to pull this up on a 6-month chart, because if we fail, we come back down close, say around 170 today, with that long tail up to 176 and change, I think we will have established the right side of a cup. So uptrend, right side of the cup, I would then look for a handle back to the 20-day. But I think the fact that this stock is breaking out and we have seen so much volume coming into it on the way up, I don't think it's over. I think we could temporarily consolidate if we fail to make this breakout at the close today. All right, just a couple more here. Let's do Costco. I love Costco, but I'm a little concerned in the near term here. Be careful if you see volume pick up and we get a reversing candle, because you do have higher prices. You've got a lower PPO, negative divergence. And look at the breakout here. When we broke back up above the prior high, I looked down and I know it was holiday week. Maybe that's part of it. but the volume was not impressive at all on this push to the upside. We have to see whether or not the volume can continue to expand as we move higher, but I would still be on the lookout maybe for a reversing candle here. IDXX, this is one we've talked about on the show before. Look at all the volume coming in. This has been a beautiful uptrend. And if I go to a relative chart, you will see that IDEX Labs has been a great performer relative to the medical supplies. I don't recall the medical supply company I talked about yesterday on the air. I think it was maybe on the 10 in 10. But I said, you know, there's so many other medical supplies companies that I would rather own. Well, here's one of them. IDEX Labs, beautiful move up, continuing to break out, great volume trends, and a super relative performer. And then the last one I have, another software, Intuit. Intuit, I've been watching this 270 area. Last few days, we've been backing off during the day, only to come back up at the end of the day to get right back to this 270, 271 area. Well, today we're trying to make the breakout. I'd like to see more volume coming in. So if there's one negative, that would be it. The group has been breaking out, but as a result of all of this consolidation, Intuit has been an underperformer, but it looks like over the last week or two, that is beginning to change. Like to see a little bit more volume to support it, though, as we go forward. So those are our chart breakouts for today. You can see on your screen the stocks that Erin covered, the ones I just went over, and I'm sure there are literally a couple hundred more out there given what's going on in the market, but those are some that we wanted to feature. All right, we also wanted to feature in the poll today several stocks. I know I went over Cisco. I think that might be one of the stocks in the poll, but then some others that we didn't talk about. Actually, I did talk about IDEX Labs as well. So there were a couple that I went over, but wanted to just take a look and say, okay, here are 6 stocks breaking out, most of which I think you've probably heard of. Which ones would you actually buy and hold for the second half of 2019? I don't know if you had a chance to look at this, Erin, but Adobe Systems, the easy winner. What do you think?
Yeah, I looked at all of these, and at first I was thinking, oh, so many of these are overbought. But then when I went in and looked at the PMOs, they're really not as overbought as they may appear. I actually picked Starbucks. It's having a great day, but I like what looks like a possible flag. The PMO, it looked on the candle glance like it was very overbought, but it is not. There's definitely more room for higher momentum. But, I'm not going to disagree with the audience here with Adobe or even First Solar. I think both of those also look pretty good. So it was just a matter of which one am I going to go with? And I opted for Starbucks, knowing how much you probably are going to keep that stock moving.
Yeah, I'm going to certainly support them in every way possible. No problem there. I did not like Adobe. And not that I don't like the chart and the volume. I mean, I think it's beginning to lead again, which I think is really important. I think there are other software stocks out there that are breaking out that I like a little bit better, but it is a great stock. I'm not saying anything bad about that. The one that I would pick, and I'm going to agree with you again, what a week we're having. And I'm going with Starbucks.
No, we are. This is awesome.
Look at the relative chart. I mean, how could you not like Starbucks?
Exactly.
Restaurants, one of the strongest areas of the market. You've got Starbucks outperforming the S&P, Starbucks outperforming the restaurant group. And look at the restaurant group. Just keeps moving up with hardly a pullback. And Starbucks looking the same, even better. So I agree with you. I think Starbucks is the pick on those 6. If I had to know I was owning for the next 6 months, Starbucks would be my pick off that list.
Wow, that's so great. No, I like it when we agree. And let's be honest, we agree plenty. It's just always fun to rib each other about it.
Well, I think it's the strategy sometimes that normally I like pullbacks and you like to see momentum in play, right? Turning and already starting to make a move. I try to catch it if I can before that move. That's really the big difference.
Mm-hmm.
Okay, great show today. Want to give a special shout out to Tony Dwyer. That was a great presentation. You can see our upcoming schedule, a number of great guests coming up. I do want to thank everybody for joining us today. Please remember to complete the survey as you exit. As a quick reminder, Market Watchers live airs 5 days a week, Mondays through Fridays, from noon to 1:30 p.m. Eastern Standard Time. Have a great Wednesday afternoon, everybody, and we'll see you back here tomorrow. Happy trading.